All right, let's go ahead and get started. You can see here the title is Back to Basics, Trading in the New Economy with Intermarket Hedging. Before I get into that, I just want to talk about how important feedback is. Most importantly, it's also about topics. If you have specific topics that you'd like to be shared with you, then definitely put that in the feedback. But one of the things that I want to let you know, we do these webinars every 2 weeks, that 1 and 2 weeks will be average trading range because we've had a lot of volatility come back in the markets as of late, and so I just want to make sure that I discuss the increasing average trading ranges, both for day traders as well as longer-term traders or investors. And then in about a month from now, we'll do order entry using limit orders, and then also protecting that limit order with a take profit and a stop loss. So there you have the next few webinars in this Back to Basics lineup. But again, I am open to your suggestions. Also, I want to address why this is called Back to Basics. We're going to prove this today, but every single foreign currency pair is its own separate entity. If you're looking at equity groups and ETFs and sectors and things like that, everything is basically due to interest rate policies that we'll talk about when we get into the fundamentals, due to a huge run-up in equity markets around the world after the past few years. Every single entity is its own, and that's what I mean by back to basics. Whether you're trading one foreign currency pair versus another, you have to look at that and know what is affecting that foreign currency pair right at that moment. Let's go ahead and just get into the quick disclaimer here. And I'll leave this up. The disclaimer is important as you're trading leveraged products. You want to make sure that you obviously are going ahead and having a trading plan. So I'll let you read that. And before we go ahead and move forward, I just want to touch on the blog here. This is my market commentary that I update about every single day. I did a lengthy update today, so I just want to make sure that you all know about that because it actually prepared you for tonight's webinar. So just keep that in mind that you can stay up to date with my take on the markets every single day at financebanter.com, and then the category is Forex. All right, so tonight we're going to get into fundamental analysis as we always do. We'll move into technical analysis. And then we'll get into the main part of tonight's topic, intermarket hedging, and then a quick review and what's next. All right, so let's catch you up on a discussion of current events over the past few weeks and what they mean for us. What's pretty slick is you can get right into that by going into Interbank FX. And how you do that is you go to Tools. So I'll hover above Tools, and then I hover over to Online Tools, and then you bring that down to Economic Calendar. I'm not going to click on that because I actually have the Economic Calendar already loaded up. We haven't had too much data this week, but let's talk about what's happened in the past few weeks. We had the Federal Reserve came out and gave us their interest rates rate and the statement that came along with it, and they said we want to keep our interest rates low for an extended period of time to buoy the equity markets. So that means that we have a weak dollar policy. The European Central Bank soon after that actually came out and said something similar, and we'll see that in the charts. But the European Central Bank said they don't see inflation, they don't see a need to raise interest rates, so they had a weak dollar policy, knowing that the United States has a weaker dollar policy, if you will. We also had a huge unemployment report that came out a few weeks last Friday. It comes out the first Friday of every month, and that actually happened to be last Friday. Came out much better than expected. More jobs were added. Interestingly, though enough, the number that comes out tomorrow, we get unemployment claims. That's the number of people looking for unemployment help, and that number keeps rising up above the 400,000 mark. You can click here, and you can open up a chart and see what's going on with the trend of it. So that's why this Forex Factory, which is a free site, and again, you can link right through from the Interbank FX website. You can get right to it. But it's a very important site with a lot of good information in there. You just need to know how to use it, but it's something that you want to become very, very familiar with. When this updates, we'll be able to see that the trend is increasing. So we added more jobs than expected, yet more people are looking for unemployment help, obviously unemployment checks. So they have to go and check in at the unemployment office in order to get that check, and more people are doing it. So very interesting how they both can go up together. So we'll just wait for this load. As we wait for that to load, other data coming out tomorrow, we have producer price index, how much it costs for producers to go out there and buy the goods that we're going to purchase from them. And you better believe if it costs them more, they're going to try their best to pass that along to us. So the Federal Reserve, though, what did they say about inflation? They said they're not worried about it, and that's why they're going to keep our interest rates low for an extended period of time. The European Central Bank said we are not worried about inflation right now. So I'm not sure how to take this number. We'll have to see what the markets do with it, and then we'll have to react, and hopefully there's a good trading opportunity. Also tomorrow, Federal Chairman Ben Bernanke does speak. So that's pretty important. Obviously, when he speaks, the markets want to listen to that. Then Friday, we have CPI, which is Consumer Price Index, how much you and I are paying for a basket of goods such as eggs, such as gasoline, such as milk. You and I know which way it's going, but obviously the Federal Reserve said, nah, it's not going up that much. I'm going to close this out because it's not loading, but trust me, the 4-week average, which you can look at on this Forex Factory website, is increasing. Also, tomorrow we get retail sales, a ton of data coming in. Look at all this data coming in at 8:30 a.m. Eastern. Producer price index, retail sales, unemployment claims, and then an hour and a half later, Fed Chairman Bernanke speaks. So a ton of data, which is great for us as traders because it means there could be a lot of good movement and a lot of good opportunity that we can react to. It also might mean if you're more of an investor, which is what we're going to be talking about tonight in the markets, basically, you obviously want to be prepared because you might be nervous about some of this data. I don't think it's going to come in too bad. Again, producer price index, I'm not sure how the traders are going to take it. Retail sales, I think people are spending. I think it should be pretty good. Unemployment claims, they're expecting it to drop from that 474 down to 430. I still think it's elevated, but it's not going to be too bad, I don't think. And that's what we're going to talk about tonight. We're going to talk about intermarket hedging. So we are all long the economy, okay? We're all at risk, whether you have a job and you're trading around that job basically, whether you have equity in your home in real estate, whether you have equity in the markets like portfolio, IRAs, pension plans, things like that. We are all bullish this economy. We need it to do well. If it doesn't do well, then obviously our livelihoods are at stake. It's going to be great for trading, but for those people who aren't day traders and who have money saved up in the markets, then obviously it can be pretty catastrophic, as we saw a few weeks ago. So we are all at risk. We need to know how to defend our positions. All right, so we do that by understanding what's going on in Forex Factory. All right, you can do that also by listening to CNBC. I'm not talking about listening about a specific foreign currency pair or a specific stock. I'm talking about listening for overall themes and what's going on so that you can kind of formulate your own opinion. Bloomberg TV, great website and streaming news on your on the computer. So Bloomberg TV and Bloomberg.com, great place to get good international view of what's going on around the world. A lot of good foreign currency related news articles in there. Your broker, as I talked about, Interbank FX, has a number of links, so use your broker and then obviously other market sites that you're already using. Technical analysis. What are the traders doing with this fundamental news? Let's look at some major trends, support and resistance, and then we'll move slowly into that intermarket relationships that we touch on all the time. All right, so first and foremost, let's head into MetaTrader 4 and start to look at some pairs. Again, I also want to address right now, this is a great place to address this, is I want to address the back to basics and show you that those specific pairs or stocks or groups and things like that are doing different things. So let's look at the pound. All right, this is this morning basically. Let's find midnight GMT time. Here goes the pound, sideways, sideways, sideways. We get closer and closer to basically the morning session for the European banks in that area and Great Britain, that area. And we have the pound went from 1.6343 to 1.65. So basically 150 pips it moved. And then it retraced that, and we'll talk about that. Well, here's the euro. They're in the same area, the same region of the world. All right, and from that same time frame, they went up 41.53 to 49.20. Let's see, we're on the wrong size chart there. Here we are. So we basically went from, let's put it back here. All right. So it's going to be hard to see because the range is a lot bigger. But we went from 43.65 to 44.15. So only about 50 or 60 pips, and then we went way down. So let's talk about that. I talked about the European Central Bank. What did they say? They said they're not worried about inflation, and they want to have basically their currency kind of weak. Not as weak at the U.S. as dollar, but it was kind of a surprise. They weren't expected to say that. So you can see this huge down move when that happened, that the euro lost against the dollar. Same time frame on the pound, okay? It went down, but not as severely. So again, let's look at that. This went from 67.52 to, let's just say, 63 even. It went down about 4.5 pennies. The euro went down from 49.44 to 42 even, so it went down 7.5 pennies, a lot more, because what was coming out of their central bank and their policy was a lot different. So that's what I mean by back to basics. You have to understand what's driving that specific currency, that specific pair. Okay, so let's start to get into some of these intermarket relationships as I've been talking about. There's a really fun relationship out there, and if you don't know it, it's really probably hurting you. It's hurting you maybe even more in your overall equity holdings if you have that. So I'm going to bounce back and forth between Options Express, which is a stock and options broker, and then Interbank FX right here. So we know that the dollar's been weaker against most currencies. Here's the pound going up, and then finally just the past few weeks falling off. Here's the euro going up, and then the past few weeks falling off. Here's the Aussie, up, and then falling off just the past few weeks. Let's look at the New Zealand dollar. Up, not really falling off at all. Let's look at the U.S. versus the Canadian. All right, as it updates. I'll blow it up so you guys can see it. U.S. weak, and then finally bottomed out here a little bit. As we know, oil prices have come down from 111, 115 back down to the $100 mark in that area. So we know that every currency is strong against the United States dollar until just basically the past couple days or couple weeks for the most part. Let's look at equity prices. Okay, this is the S&P 500 right here. So what you have is the S&P going up, and then all of a sudden, just the past few days, past couple of weeks, basically, this is a daily chart, started to fall off. So there's your overall relationship. The dollar goes down as the equity markets go up. The dollar goes down, what else goes up? Well, oil goes up, gold goes up, all of those things that basically we're importing, all of those things that are priced in dollars. And as the dollar gets weaker, those other commodities get stronger. Who exports a lot of gold? Australia. Their dollar is stronger than the United States dollar. Who exports a lot of energy? Canada. Their dollar is stronger than our dollar. So you have to start to think about, basically in foreign currency terms, what countries are producing some of these goods, and then if you're looking at the stock market, what's going on with some of those as the commodities and commodity stocks, commodity sectors, things like that, as the dollar gets weaker or stronger. So here's that rough relationship. Equities up, dollar down. Equity sideways to down, dollar up. Remember, we still have the lowest interest rate out there, but other places have said certain things, like the European Central Bank, that are causing that to move, the euro to move. Remember, the euro got weaker against the U.S. dollar, but I'll blow it up here. Look at it on a long-term time frame. Okay? It's gotten weaker, but it's gotten weaker a very small amount compared to the move that it's made up. So let's just wait for this to update, and you guys will be able to see this. Okay? So here is just looking at 2010 in June. All right, so here's June, July, August, September, October, November, December, January, February, March, April, May. So the euro went from 1.17 or 1.18 to 1.50. Pretty big move up. We've only come back down a little bit. So that's what I want you to be thinking about, is these relationships again, and what does it mean for you as a trader? Let's go further into, we're going to leave the Forex and just go back into options for just a moment. So let's look at some different ETFs out there. Let's look at gold prices, because gold and the Australian dollar have a very nice relationship. And we'll let this update, and then it'll come through to you just a little bit after I see it and start talking about it. Okay, so here's gold. Here's gold going up, 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 a little bit of a hiccup and then kind of sideways. Let me just bounce back to the Australian dollar for you guys. Here's the Australian dollar going up, 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 and then we have a little hiccup. They look exactly the same. So how can you play this basically? It's very hard, technically wise, to just say, I think gold is overvalued and it's going to go down. So I don't see many chart patterns here that cause that basically, and that's what we're looking for is a fundamental shift, the Federal Reserve saying, hey, we're going to strengthen the dollar, which they haven't said, or the technical pattern like double tops and things like that. We haven't seen that. Can we see any of that in gold and find some kind of a relationship? No, it's been very tough here. So I'm not saying that it was easy to catch this down move. But what I'm saying is if you hold a lot of gold or gold stocks, as it goes up, 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 you have to think, well, if you're an optimistic person, is it just going to get better and better and better? Great. If you're not so optimistic and you're nervous and you want to generate income, you can do certain option strategies where you can create income into your account, like what's called a covered call. Or you could do puts to protect it, and when the stock goes down, you make money on your puts. When the stock goes up, you lose money. Think about it as insurance. You have auto insurance, you have health insurance, you have life insurance, do you have portfolio insurance? So that's what I work on as a boutique consultant. That's Jupiter Peak Financial. I basically look at someone's individual situation, whether they're young and in college and they're just starting out, when you don't have to worry about protection. We're just going to go and see if they have the time to trade. We're going to go and trade and learn the principles of the markets. If you're 60 or 70 years old and you have a nice pension saved up, if you have IRAs saved up, if you have money in the real estate market, we're all along the economy, and if the economy doesn't do well and the stock market starts to crash, you lose your value. And as you get closer and closer to retirement and you're relying on Social Security or your investments to basically pay you out and have a nice retirement, well, that could go away very quickly. So that's why financial advisors move you further and further into cash or bonds and income generating things as you get older and older and older. But let's face it, how much money can you get from bonds right now? So if you want to keep money in the stock market, that's fine. But if you want to protect your money in the stock market, there's very nice ways to do that using option strategies to do that, or understanding these intermarket relationships and using the dollar to basically hedge yourself because you understand the relationship. If you see equity prices and they go up 800 points like they did in a few days, I'll show you that move right here. Let's see this on a much shorter term time frame. There was about, and let's actually go to, we'll go to DJI because you guys can then see the Dow Jones very, very, very easily and understand it. So let me just bring up the Dow Jones because that's on the news every day, and I think most people can grasp that and understand that. Okay, here's the Dow Jones, all right, at about 12,000. 1 day, 2 days, 3 days, 4, 5, 6, 7, 8 days, 12,830 points, all right? So 830 points in 8 trading days. Big move or small move? Massive move. You know, almost basically 8 to 10% in 8 days. It was going up 1% a day. You might look at it and say, wow, I understand the markets. I understand what's going on. I see the unemployment data. I see initial claims. I see this and this. I hear what's going on in the Federal Reserve. I'm paying attention. Great that my portfolio just went up 8 to 10% in these 9 days. But you know what? That's too good to be true maybe. Maybe I want to take some off the table and lighten up and go to 5% cash instead of 3% cash. Maybe I want to do some income generation by understanding option strategies. Maybe I want to protect myself, and I could use that a number of ways. I could buy puts in the markets. I could buy puts on specific stocks that I own. I could buy puts on the S&P or ETFs to protect my investments as a broad basket of stocks, basically, and knowing that if the broad markets go down, then my puts on the overall markets will make money. And it's basically my hedge. Or I could say I understand the relationship that if the equity markets go down, the dollar goes down. Remember, everything that I'm saying here is past performance. There is no guarantee that it works in the future. This is a relationship that's worked in the past. The bottom line is it's not guaranteed to work in the future. You still have to go back to basics. Look at the pound versus the U.S. dollar. If you think the pound is going to go down against the U.S. dollar for whatever reason, was there a double top? Was there a moving average it hit? Was there a trend line that it hit? What was your reason, and did you build a trading plan around it? That's what's very big for me with my students. If they say to me, I'm going to make a trade, and they don't send me a trading plan, I'm not even going to review it because I don't know what they did. They don't know what they did. They can't learn from it. So you have to make a trading plan. So we could look at the pound versus the U.S. dollar. maybe we want to draw a trend line on the tops here, something like that. Maybe on a shorter term time frame, we went down and we moved it down and we have this trend line coming in. Maybe we have some tops here, and then we said, you know what? I think that there's a lot of resistance around 1.6727 or so. And now I'm not just a day trader, but I'm looking at this for more of a longer term trade. And I have this trend line in here. I might put my stop 50, 75, 100 pips above it, up at 68.27 or 69.27, risk a couple hundred pips. And if it goes down 2 to 3 or 400 pips, risking 200 to make 300, risking 200 to make 400, that's a good trading plan, and you have that in place. No guarantees. It busts through the trading plan and goes to the upside. Thank you very much. I have my calculated loss. It made sense for you as a trader. That would be a hedge, basically. The shorter-term trader who's not worried about hedging might see the same exact trade, and they might say, I'm going to get in at 67.27. I'm going to risk 20 pips, and if it goes to 67, let's say 66.27, and I make 100 pips out of it, and it goes right down to here, great. So they risk 20 pips to make 100 pips, and the exact same trading reason to get in, just two different traders, two different types of traders in two different specific scenarios, in two different places in life, in account sizes and risk tolerances, whatever it may be, looking to achieve different results. But the entries may very well have been the same. So that's what's fun about it, is a lot of people can use the same entries. They may use different exits and things like that. It all depends on what they're trying to achieve. So that's what you're looking for, is basically to understand, once you understand that big relationship that's been in place in the past, I'm not saying it will be in place in the future, but it has worked in the past, that if you use it again, you're saying, I'm bearish on the equity markets, that should be bullish for the dollar. I could be wrong. I could lose on my dollar trade, and I could lose in the equity markets as they go down. That very well could happen. Again, it all depends on what's causing these markets to move and what's driving them. So, if you thought that the euro was going to be a good purchase, because the trend has been up and you're looking to buy it, well, and then they had the European Central Bank said, hey, you know what, we're not too worried about inflation, we're not going to raise interest rates, and it slices right through you. So again, that's why it's so important to pay attention to the Forex Factory, know when data is coming out and what it means for you. You can interpret it, you can listen to CNBC, you can read stories on it, and then you can start to decipher and say, is this a good trading location for me? Do I see this as a good opportunity? All right, like I said, if you guys have any questions, you're welcome to go ahead and throw them in there as I go through this. If you want me to look at specific pairs, if you want me to look at specific stocks, if you want me to look at specific relationships, specific sectors, things like that, whether it's financials, whether it's commodities. Again, as I mentioned on the blog, I posted, let me get back to the address. On the blog here, I posted a lot of stocks, a lot of good trades, fun opportunities today. Because as I said, I'm going to talk about the average trading range in 2 weeks. Why am I going to talk about that? Well, I'm going to talk about that because of volatility. Look what volatility is doing. And the way that you find that is you go into an equity chart, basically, whether it's your broker or just online, and you look at what's called the VIX, Victor India X-ray, VIX. And I'll bring this out on a longer term chart so that you guys can see it. Okay? Let this update for you guys. All right, so here's the VIX. When the VIX goes down, let me actually bring it out even on a longer term time frame. When the VIX goes down, that means volatility is going down. That means there's less fear. The VIX is a fear gauge. So fear spiked up. This is back in May of last year. That's when the BP well happened. That's when the stock market dropped significantly. Here, this spike just about a month or two ago, you guys know what that was. That was Japan. And then all of a sudden, after Japan, the stock market went higher and higher and higher and higher and higher, and the VIX went down and down and down and down. So what the VIX is doing is saying, the lower I go, the less fear or uncertainty the market has, the less movement there's going to be. So whether you're an option trader and you buy options and you need them to move to make money, or whether you're an option seller and you're looking to get a good premium, you're going to get less of a premium when there's lower volatility. If you're a Forex trader, intraday trading, the average trading range is going to be very small because there's not that much excitement going on. Well, volatility has picked up just a little bit, but overall, we're still very, very low on the scale. So these have been good days in foreign currency and good markets and good opportunities, but overall, it's not happening just every day, boom, 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 we're getting opportunities. Sometimes you, as a day trader, you go in there to the markets like yesterday, and it was a very slow day. So let me just show you the difference between today and yesterday. When the markets went up yesterday and kind of sideways, there wasn't that much excitement. When they went down today, there was a lot more excitement. So let's look at that in the pound versus the US dollar. All right, let's look at, we should be able to do it here on a 30-minute chart. All right, so here is yesterday, the 10th of May at, I'm going to find midnight GMT. Okay, so midnight GMT, we were at 64.14. All right, we dropped down basically by, let's just go midnight to midnight. So we were at 63.58. So the high of the day was 64.17. The low of the day was 63.21. Okay, that's 100 pips from high to low for the day on the 10th of May. Markets weren't too active yesterday. Stock market went up. No volatility. Hey, everything's great. Stock market's going up, up, up every day. And remember, the stock market went up 80 points yesterday. The day before that on Monday, it went up 60 or 70 points. The day before that, Friday, it went up 50 points. So 3 days in a row, hey, nothing to get worried about. Nothing's going on. Then you see midnight today on the 11th. We're down around 63.44. During the European session, we went to 65.13. We went up 150 pips. Yesterday, we had a range of 100 pips. That was it. Today, we go up 150 pips, and then we went from 65.11 down to 63.20. We went down 200 pips, up 150, down 200. That's 350 pips of movement today, 100 pips of movement yesterday. You tell me the better day to be a day trader and active trader. So that's what I mean by is you have to understand what the markets are giving you. We can't just go in every day and wake up and say, I'm going to trade, 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 trade. You have to let the markets dictate what you do, what strategies you do if you're an option trader, what you're going to read basically and pay attention to if you're an intraday Forex trader, what is driving this big up move, what's driving this big down move. So remember, the markets were up in Europe basically overnight. The stock market in the United States was flat basically when we opened up today. Then all of a sudden it started dropping 50 points, 70 points, 90 points. So right here is basically the time when the stock market opened in the United States, right about here, okay, 1:30 GMT time. So we weren't too far off highs. We were at 65 even basically, and we backed off to about 64.50. We only backed off 50 points. Then the stock market went down 50, down 75, down 100, down 120, down 150, down 180, and the pound went from 64.52 to 63.15 basically, so down that 150 pips or 175 pips or so. And then the stock market climbed back. Instead of closing down 180 points, only closed down 130, and they bought back up the pound a little bit there. So stock market flat, pound up, stock market down, pound down, dollar up, stock market back up a little bit at the end of the day, pound up, dollar down. Very nice tradable relationship. That could change tomorrow for all I know if there's some kind of huge event around the world. But the bottom line is you will see, you will feel, you will know that this is in play, but you have to pay attention to those inter-market relationships and what's driving different markets. But pay attention to yours specifically. All right. Let's go back in here and get further into the outline. So again, let me just review here. Why intermarket relationships? As I said, we're all along the economy, jobs, businesses, real estate, and then portfolio insurance. How many of you have portfolio insurance? We have auto, we have health insurance, we have life insurance, but do we have protection to the downside? Remember, hedge funds do this for you, okay? You can pay a hedge fund manager 10, 20% basically, and they can go ahead and do this for you if you have a certain amount of money. In America, to get into a hedge fund, you have to have lots and lots and lots of money. You guys can learn to obviously be your own hedge fund by paying attention to what's driving these and paying attention to these relationships and protecting your equity holdings, protecting your gold holdings, protecting this sector by understanding these big relationships. All right. So how many of you have portfolio insurance? Some of you might start to think about it if you're in that situation where you have a nice nest egg built up. Also, have you seen the market returns over the past 2 years? Do those market returns make you nervous at all that, hey, unemployment in the United States has climbed or stayed steady around 9% or above, and the stock market's gone up a lot? How much? Let me show you. Let's look at the S&P. We'll just stick with the Dow Jones. Let's look at the Dow Jones, and we'll pull it up on a long-term chart for you guys to see. I'll let it update, and then it'll just come across to you just a little bit slower. Let's pull it up on a 4-year. It's amazing that the crash 2007, 2008, 2009, that's already 4 years ago. So here we were at 14,200. We fell all the way down to 6,400, lost more than half of our value, basically. Then from 6,400, we went to 12,800. So we doubled, exactly doubled. 64 to 12,800, we exactly doubled. So basically you look at that and you say, wow, we dropped about 7,000 or 8,000 points. We came back up 6,000 points. So we basically came back up 80% of the way. Is the economy out there where you're seeing, are people happy enough to make it 80% of the way back and maybe even higher? I don't know. That's Federal Reserve policy, low interest rates. So big businesses can borrow money very cheaply. They can add expansions. They can add workers and things like that because they're basically able to lend money to investors and debtors and creditors and things like that for very, very, very cost-effective ways to do that. Much cheaper than they could when interest rates were 5%, 6%, 7%. Now they can do it for 0.5%, 1%, 2%. So that's the theory behind the low interest rate policies. The big companies out there like Walmart can basically refund their debt at 5%, offer debt now at 2% or 1%. That money is now basically cash in their pockets. Now they can go and they can do expansions and add things, and hopefully that infiltrates down to you and I if you're looking for a job basically as just Joe Schmo American. It obviously hasn't worked, though, because our unemployment rate hasn't changed. So it hasn't worked yet, but maybe it will work 6 months, 9 months, a year, 2 years down the road. Unemployment will go 9%, 8%, 7%, 6%, 5%, and the markets are trying to price that in. The markets are always looking ahead. So you have to ask yourself, you've seen your portfolio come back 80% of the way of where it was a few years ago, and now you have to say, am I confident it's going to go higher? Great. Don't do anything. Let it go higher. If you're nervous about it, then you can start to protect it using option strategies, using intermarket relationships. So again, that's what I focus on, is basically understanding where a person is, and if they need to put these in place for their own situation, then we go ahead and work that through. So that's basically the question. Are you confident the stock market will hold on to its gains? Maybe it gets way better. We don't know. So there's that intermarket hedging, U.S. dollar relationships, understanding commodity pairs. The gold and the Australian and U.S. dollar pair are exactly the same. All right, so let's go back to that really quickly. Let's go back and take a good look at the Australian dollar. Up, 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 little hiccup and down, and then let's look at gold. We'll have to shrink down the time frame for this. So like I said, just let it go ahead and reset itself. So here's gold running up, 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 and then finally a little bit sideways. So it just has these little hiccups, but it looks very, very similar. I'll actually put the Australian dollar on a much longer time frame so that you can see them together. So let's see here. We have 2 years of data on the Australian, on the gold chart here, and then we have basically, let's see here. We have a lot more data here because this is a weekly. Let's put it on a daily for the Australian dollar. So there's about a little bit less than a year of data. So let's go to the weekly and move this over. So there you are. There's a few years basically as gold went up, 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 had a little bit of a fall back when the crash happened, obviously. And then from 2008, the past few years, 09, 10, and up. Look at it. It went from 62 cents to $1.10. 62 cents. Very, very cheap to go to Australia. not so cheap to go to Australia these days. So they're going very, very similar directions. Let's look at the United States dollar versus the Canadian dollar. Okay? Here it is basically over the past 6 or 7 months, August to now. August of last year to now. 106, our dollar compared to their dollar. Our dollar is now 96 cents compared to their dollar. It dropped 10 pennies. Let's look at oil prices. Okay, so we're switching from gold, but we're staying in the commodities, understanding that the dollar base, that these commodities are priced in dollars, and we have a weak dollar policy. So let's look at what USO has done. There's a chart of USO. So percentage-wise, look at these moves, $31 to $45. A very, very short period of time. May of 2010 to April, basically a year, it went from 30 to 45. That's a $15 move of a $30 stock. That's only 50%. Who would like a 50% return in a year? Yeah, exactly. Understanding these relationships, it start to make sense. Who wouldn't want to start protecting some of their gains if you had a 30, 40, 50% gain in your portfolio because you hold on to a lot of commodities or oil stocks and things like that? Who wouldn't want to protect them? So let's just go. We'll go look at BP. Let's look at BP and see what it did in relationship. Again, back to basics. Every single thing that you're trading is its own entity. Sometimes there's relationships out here, but you have to have a trading plan for each and every foreign currency pair you trade, each and every stock, each and every ETF, each and every index out there. You've got to have that trading plan. There are no guarantees out there. You've got to trade with the right size for your account. If you don't know how to even arrive at the right size for your account, which is called an account risk or trade risk, you need to go through those steps and understand that. That's really of primary concern for me right away when I'm talking with someone. Do they have realistic goals given their account size? And then do they understand what they can trade and time frames and things like that and styles of trading given how much time they have? If they can day trade, great, but we're going to make sure that we trade appropriately the amount of contracts for their account size and what they're willing to risk on that specific trade. Every single trade is very, very different. You have to go into each trade and understand what you're doing for that trade and build it from the ground up. Here's BP. The stock has done very well. It went from 27 all the way up to 50 basically, and there was probably a split or something like that in here, I'm sure. That's maybe why these stock prices are a little bit cheaper. 27 to 50, that's a 100% gain. It's gone sideways now for January, February, March, April, and May. It's basically gone sideways now for 5 months. Well, certain option strategies let you make money on sideways stocks, let you generate income and build money into your account. So that's where intermarket hedging comes in. Understanding what a covered call is if you own stocks. Understanding what married puts is if you own stocks or mutual funds. Understanding what bear calls are. These are income generating. These are growth producing trades for your equity accounts that make sense when you understand foreign currencies, you understand overall interest rate policies, and then you look at what you own, where basically you might have some open wounds if the stock market starts to go to the downside. So to review, we talked about macro events out there like ECB meetings and Federal Reserve meetings. We talked about micro events basically affecting pairs much more closely, maybe a much smaller event, news event, something like that. Also those relationships. We talked about trend and support and resistance, looking for good areas to get in. That's really, really important. If you understand a trend, which way the trend is moving, the Australian dollar has been moving up, up, up against the US dollar. If you understand where support is, where people are buying it, if you understand where resistance is, where people are selling it, these can make you a very, very good, safe trader. No guarantees. That's why we always put stops in, but at least you're not trading in the middle and you don't have a poor risk reward. Support and resistance at least give you a good risk reward. No guarantees it works out, but you're risking 1 to make 2, 1 to make 3, 1 to make 4, instead of risking 1 to make 1, or risking 2 to make 1, or risking 3 to make 1 if you don't know how to read charts. You've got to know how to read these charts. Intermarket relationships, I do believe they do provide trading edges. No guarantees. You're not going to have a winner every time, but I do believe that they provide good areas to look for opportunities, high probability opportunities. Intermarket hedging depends on you and your account. And then you can also use various markets, options, Forex. You can use various strategies. As I showed you in this slide, you can use covered calls to generate income, married puts to grow your account when the account goes to the downside and be hedged basically, and then bear calls also to generate income. So next webinar, we'll go through the same thing. We'll do a 2-week catch-up on all of the fundamental news out there. We'll talk about technical analysis of pairs. We'll go into our intermarket relationships, which are so important and so key. And then we'll get into average trading ranges so you can see how the volatility's picked up of late and how it's changed basically the trading that we've done from the past 4 or 5, 6 months that have been much lower volatility to a little bit of a pickup in volatility. Where can you get more education? Interbank FX, your broker. You can go to the education and then the Forex education tab there basically. You can go to YouTube where we download all of these so you can see the past few webinars that I've done on YouTube if you just go to Interbank FX videos. There's also a daily trading edge that they have on Interbank FX. So again, more of commentary coming from different people, and then also you can see my commentary basically every day. Every day that the markets are rocking and rolling, I try and update it. So financebanter.com/category/Forex. So I thank you very much for your attendance tonight, for your questions, things like that. Again, bottom line is you've got to understand who you are as a trader. What are you trying to achieve? Who are you as an investor? What are you trying to achieve? And then start to understand relationships, the fundamental relationships, and then start to build trading plans using the charts. The charts are kind of like your lifeline. If you turn the page in a book, you learn something new. When the charts update, whether they update every minute because you're a day trader or they update every day because you're a longer-term investor, you learn something new. They help you to build a trading plan. No guarantees out there. You've got to trade the right size for who you are, and you've got to manage that trade using the charts. So thank you very, very much for your attention. This should be downloaded pretty quickly onto YouTube, and you guys will have access to it. So again, thank you, and see you in 2 weeks.